Two Bulls in a China Shop is brought to you by these great companies that are giving us money to let you listen to their stuff.
Bullshit, Kyle. We make this show. You and me. Two Bulls in a China Shop is brought to you by us.
Someone's got to pay the bills, Dan, because it's not our trading.
All right, roll them.
Finding the right person for the job isn't easy. Just ask someone who hired a drama coach to be an IT guy.
Yeah, I'm having trouble logging in.
I'm not buying it. Say it again, this time with feeling.
I can't log in?
Come on, man. I want to feel your struggle.
But if you've got an insurance question, you can always count on your local Geico agent. They can bundle your policies, which could save you hundreds.
Now, like your life depends on it.
I can't log in.
Yes, we'll make an actor out of you yet.
For expert help with all your insurance needs, visit geico.com/local today.
Sometimes you need to take control to make a difference. That's why with FlexPath from Capella University, you're in control. Set your own deadlines and leverage your experience to move at a pace that works for you. Discover a different way forward at capella.edu.
You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
Well, hello and welcome, everyone. Welcome back to the China Shop. We are so delighted you made it today. We got another exciting edition of Back to the Futures. Get on inside. Special store hours. I'm Shopkeeper Dan. With me is Kyle, creator of financialineptitude.com. Kyle, on a scale of 1 to about to go into space, how excited are you today?
I am full staff right now.
Full staff.
All right.
Got your own towel rack going. You're so excited.
Yes.
Oh, Kyle's clearly Marty McFly. I'm the bald high school principal, and we are joined with us today by Job. Job, are you more of a Biff or a George McFly?
I like to think of myself more of a George. You know, not as cumbersome as a Biff.
Wait, which George? George at the start of the show, or George at the end of the movie?
Well, maybe even a blend with like George of the Jungle.
Oh.
Oh, fantastic. All right. Everybody ready to get back to the futures?
That's right.
Yes.
Fantastic. All right. I believe, though, we should start out and ask Job, any big news coming out of OrderFlow Labs?
Yes. So OrderFlow Labs has just gone through our first year this month, in fact.
Oh, it's only been a year?
It's only been a year. How about that? But it's been a very exciting year. The expansion that we've had in tool development is pretty impressive. You know, we started out with a handful of tools, and now we've grown that 3 or 4-fold, and they're extremely efficient with automation and utilization for intraday application.
Mm-hmm.
So we are doing an anniversary sale here. It's active right now.
How long is that sale going to last?
Well, I think it's a marketing trick. You got to use scarcity to get it to jump. So this sale's only going to last for 1 more hour.
But we got to make sure we get this episode out before the sale ends.
I'll get that date on here because I know we're getting to the end of July.
Yeah.
But let's dive into today.
Did you want to speak to the new partnership you guys had too?
Oh, yeah. So we partnered recently with Trade Day, which is a prop firm for trading. And that was on the quarterbacking of Leo. You guys know him as Leo the Tiger on Twitter.
Yep.
But we had a nice webinar with them the other day to kind of get a little background on their development for where they came from. So these guys, they have an extremely long set of credentials, trading from the early 90s up and through now. And they've gone through different investment means as far as work and trading and funding for different individuals and firms. Now, they do have some unique aspects to that prop system in that they don't have your predatory trailing profit loss. So everything is it's an end of day account balance that comes into play there.
Mm-hmm.
And so they start you off with a reasonable amount of risk in order to grow. And as you expand, then your ability to access larger positioning is based upon your performance. And so, like I said, they're not pulling up stops like I think was it Top Step and Apex and
Can we call them out?
I'm sorry.
Can we call them out?
I'm sorry.
Apex sucks.
But basically, they're looking to put people on their desk. Whenever you finish an evaluation, you're not just trading another simulated account, you're trading live funds. And they're also there working with you to improve your efficacy intraday. And so they take the time to actually do that. Whereas, and it's not just a handful of generic videos that say, hey, we've got this moving average and above it means this.
Right.
These are guys with experience, and they're not interested in the Joe Blow that's coming out just to wing some lottos.
Right.
They're looking to develop traders and have them on a desk in their fund. And that's what I really like about them. And so it's an exciting addition here to OFL. So what OFL is doing, why are we partnering with them? Well, you can be an affiliate for any of these prop firms. And as an affiliate, you can go ahead and you get kickback for whatever the discount it is that they give to somebody. But we're not interested in that. And so after discussing with them, what's happening is any type of kickback affiliate side is actually going to go to the individual as a price off of their membership. And so that's a special thing that's happening through OFL for OFL members. And they will have that discount from that kickback for life.
Oh, that's awesome. It sounds like what we did with Trade Pro. The money from the kickbacks wasn't as appealing as trying to get people access to stuff for a better price. I'm definitely going to check them out too, because I like the idea of an actual prop firm that has like a vested interest in trying to make you a better trader, as opposed to just like the other ones have been. I'm not gonna badmouth too many more of them. I think I've done a good enough job of that for the past week.
It's an exciting thing, and I know that there's a lot of individuals who are looking to grow their understanding and their trading abilities, and having that access to be on an account that's going to benefit them as far as financially, but also benefit them as far as growth and in their experience. It's a good working relationship there.
That's really exciting. Can't wait to check that out. Make sure we put links to that in the episode description for anybody else who wants to take a look. But sounds like now it's time to start talking about some volume profile.
Nice segue, Kyle.
So today, thanks for having me on. We wanted to talk about assessing inventory with volume. All right, and you've had a few episodes leading into this that have been excellent, discussing the auction itself. And volume is more of an aspect of my personal trading. And so, what does volume tell me in an auction? Well, the transacted volume itself signifies that there's interest at a certain price level. That interest being shown as volume, or lack of interest, which is shown as not having volume. So if price is the advertiser, as price moves, it either it excites you to get into the auction, or it goes down, it provides fear to remove yourself from the auction. As price moves, it's advertising. And so during that advertisement, if volume is expanding, growing, that shows me interest at that advertised price. Conversely, as volume dwindles, that lets me see a lack of interest. So application of this from a trading sense, and we're going to dive into that, but it's important to just think about volume as interest in that advertisement of price. And you're going to be able to manage risk correctly and find areas more applicable to your entry styles. And so this is going to occur on different time frames. And so viewing volume can be done in several different ways. We're going to talk about how there's different tools for visualizing volume. With regard to that, I'm going to put a lot of the emphasis on volume profile, showing volume on the horizontal axis at the level of price. So viewing volume can have several different aspects, but regarding time frames, it's important to know that if you spend a lot of time in a particular area and you don't build a lot of volume, then it's not exactly accepting it.
Can you expound a little bit more on that?
Yeah, so let's say we push up to like all-time highs and we sit there for a few sessions.
Mm-hmm.
But with regard to the prior session or where we came from, if it's not expanding to the same degree, if it's not building volume on that horizontal axis, then it's spending time there. It's just not finding interest. And therefore, when it moves back to where it priorly was accepted, it's essentially rejecting that zone.
Interesting. So time is not nearly as important as the actual amount of volume that trades in an area.
I'm not going to say that it's not important, but for my style, the amount of volume is going to be a kicker here.
Mm-hmm.
Yeah,
that makes sense. I think actually,
and I'm going to give an example. So if we take something like a parabolic blow-off, okay,
mm-hmm.
what's a parabolic blow-off? That's something like think about the COVID fall. Price just dives down, and then boom, all of a sudden it stops on a dime and reverses, right?
Mm-hmm.
It didn't spend a lot of time down there, but it sure as heck built a lot of volume.
I'm pulling it up on my chart right now so I can take a look.
And so a parabolic blow-off, even if you look at volume just directly underneath the candle, you're going to see huge spikes of volume.
Mm-hmm.
But the time aspect, it didn't spend a lot of time there. So therefore, you have a lot of stop activity, a lot of offsides activity. The time aspect of that rejects, gets back into prior acceptance. And that is usually an exhaustive type activity. So when we say time is not as important as volume, time plays into this because you can build volume and reject it. And if it happens swiftly, then you have a quick change of course.
Mm-hmm.
So brief time up or down if volume takes place but reverses immediately, then that new leg in the auction has shown itself and should be then the dominant leg of direction.
Uh-huh.
So that's a liquidity grab for positioning or trapping, you can call it, where either stops are hit but contrarian orders are there to fill or feed on the fear or euphoria, but then initiate in the opposite direction.
So when you see something like that take place, when you see like a really sharp sell-off and then a sharp reversal, that's your confirmation that the move or the sentiment has shifted, but that's not necessarily your entry.
Correct. Yep. I like to let it show its hand first,
mm-hmm.
and so I'm not one ticking the bottom on that.
Right.
I'm letting that push out because now we've built structure, and below where price is, now I can see where there's less interest. And as price moves around and works on building volume above that low,
mm-hmm.
I'm going to be trying to initiate a position as close to that low volume zone as possible below me. Because I know that if they escape or push back through the low volume into the prior area of acceptance, then they can just traverse the other side. So this allows me to have a very tight risk, especially utilized in intraday.
So basically, if that low gets taken out, then you don't want to be long anymore anyway. So
yeah. And so allowing it to show its hand and having that structure beneath you is key. Now that's more of a swift rejection.
mm-hmm.
Now another way to look at this would be if price is pushing down and volume is just simply tapering or dropping off, okay? And it's thinning and thinning and thinning, and then all of a sudden you have a pushback, a reversion type pushback.
Mm-hmm.
That is on a taper. That is something that I'm more likely to step into quicker.
Okay.
Because rather than building a distribution there and then building a distribution above it, it's rejecting a lack of interest, and that profile completion or the price is going to start to gravitate towards the bulk of that interest, and the higher volume may be much higher above.
So the big volume nodes, then those are kind of like price magnets.
Yeah, they're like magnets. And so I've described this in a few different podcasts, but thinking about this on like a science background, if you have a nucleus of an atom Okay,
Ooh, you're talking my language now.
of an atom. Okay, and you have electrons that rotate around it. We've all seen a picture of a nucleus and how electrons circle around it. Now that circle, or the distance it is from that nucleus, is called a valence. Okay, that's just a term for the zone that it's in. Now, if that electron goes further away or gets out of that circling pattern, it will then be attracted to another nucleus. Okay, that other nucleus being the next high volume zone. All right, and that valence being the low volume area.
Interesting.
All right, so that's just the way that I visualize that. And the auction process to me is that circling pattern, building interest around a zone, and then escaping that valence, going to the next one. The market is trying to create a giant Gaussian distribution.
Is that why the low volume nodes seem to be a big interest to traders? Because I always wondered why it seems like those low volume areas sometimes end up being the spots that hold.
I don't know two traders, but that's a very low volume areas are areas that I like to engage.
Why is that? What's the psychology behind that, or the thought process?
It's getting to the edge of a distribution. So if you think about a distribution like a bell curve, all right, and that bell curve, the belly of it, the top of it, is your high volume node, or the area of most volume there, which could be a POC or point of control. You're going to have a distribution of activity around that high volume area, right?
Right.
And there's going to be less on the edges. Now, as the auction rotates around that distribution, if it escapes a tail, that tail being the low volume area, then it can create another bell curve, and that's showing acceptance there. So yeah, those areas, those edges where there's the least amount of interest is where I'm looking for absorption to bring back, or if it breaks out, I'm looking to catch a rebid or reoffer from that location, that low volume area, for continuation.
Okay. So it's sort of like it's like going to your valence shell analogy. Like the further away it gets from that, like there comes a tipping point where you can see where the next attractant is going to be at.
Correct.
So you know that you have limited or you can minimize your risk because you know that if it continues too much further down this way, that it's going the other way.
Correct. So I like to manage risk against the opposite high volume edge. Okay. So think about this. You have a low volume area, and it looks like a dip in that volume profile. And let's say I want to get long as it's coming down to that low volume area. Within reason, as long as it's within my risk parameters, I will place my stop on the edge of where that volume starts to increase just beyond the LVN.
Aha. Interesting. Okay, that makes a lot of sense.
And so as it pushes into favor and starts a leg in your direction, then you can watch it build and confirm that move in your direction.
Okay, that makes a lot of sense.
So there's different pieces to this auction process. I mean, we talked about time, price, and volume. Price being the advertisement, and you can see this utilizing candlesticks, your DOM. I mean, it's on everything you're going to be looking at. You're going to see the price. Time. A lot of individuals use TPO or time-based candlesticks. And volume. Volume can be the volume profile, the horizontal volume. It can be directly under the candles. It could be a VWAP, delta, total volume. We're going to talk about those pieces of the puzzle. But there's three pieces to the auction. It's the time, price, and volume. And that relationship presented helps apply the style of the auction that you're currently viewing in front of you.
So I'm just looking through your notes here.
That's all right. You want to talk about volume types?
We kind of blew past the time frames, and I kind of want to go back to that before we get too far.
Oh yeah, let's go back to time frame. I think we stepped into the parabolic blow-off a little bit.
Yeah, and that was super interesting. I didn't want to stop you.
Right.
So time frames are important in that when you're intraday trading, if you're trading off a 10-second candle, you're not going to see what's happening on the entire week, or you're not going to be seeing what's happening on the session, right? So there's a few time frames that specifically continue to be important. The auction can change its face or its character in a reasonably short period of time, And so with that being said, looking at a volume profile from 4 years ago is not going to feed me for any of my trading as much as it will looking at a volume profile of last week.
Mm-hmm.
Okay. So understanding a lot of my planning comes from the week in, week out basis. And so if I zoom out, I want to have an idea of where I'm at with respect to last week's.
Right.
Okay. To help with my planning. Zooming in, then I want to know what happened in the overnight session.
Mm-hmm.
So I have that visualized on my chart. And that is something that will act as a guide for when RTH, or the regular trading hours, open and begins to build a new profile against it.
Hmm.
So if you're jumping on a trampoline and you want to do a backflip, you don't just start rotating indefinitely. You got to know where your feet are going to land, right? And so knowing initially before that session starts, where are we with respect to last week? Okay, here's where we are. Now I'm going to set that aside. Now I'm going to focus on where are we with respect to the prior session.
Mm-hmm.
And that's going to help me be on the right side of the leg as it's occurring, and be out quick enough if that sentiment or that interest changes.
Which side do you give more weight to, overnight or RTH?
As I'm trading, a lot of my RTH planning comes from overnight and prior RTH. So those two give me information. And then during the trade process, I'm physically watching the volume building as the profile builds.
Mm-hmm.
And that helps me. That's one piece of the puzzle that lets me make a decision on whether or not risk is being put on.
And do you zoom out and look at do you look at it with the idea of the people who are long-term traders are going to be interested at these points. The swing traders are going to be more interested at these points. Day traders should be interested at these points. Do you map out the different time frames, areas of interest as well?
Certainly, but in my opinion, it's not as easy as splitting them up into day traders, swing traders, and long-term positioning.
Mm-hmm.
But you can successfully trade an intraday range from the prior session's low volume areas and lack or presence of build, and that can give you an idea of direction on the day.
Okay.
And that whole piece could be inside just the bulk or the middle of the previous week, right?
Right.
Whereas if we're pushing down to a large low volume area from the previous week, then obviously that's going to give more weight than just trading kind of in the middle where that's occurring.
Exactly. Yeah, because the more time frames that get interested in an area, it seems like the level should be given more consideration in your plan.
Yeah, in a sense, you could even visualize that profile like that as a fractal.
Ah, right.
Yep.
All right. Let's see. The 3 puzzle pieces. We started talking about the different ways. I think you're going to start talking about the different ways we can visualize volume.
Yeah. So we talked about time, price, and volume. So we're going to put the emphasis on volume here.
Mm-hmm.
And one of the primary ways that I utilize this is called volume by price, or the volume profile. And what that's doing is displaying volume on the horizontal axis at the price. So if we're trading, for instance, at 12,000 on the NQ, and there's 1,000 contracts that come in, instead of placing it below the candle like a little vertical histogram, it'll be placing it at that price.
Mm-hmm.
And so if price goes up and volume goes with it, and it keeps building as it goes up in price, then that's growing the volume. That's what I call a volume build.
Mm-hmm.
If as these rotations in price occur through the day, you're going to see this volume growth and oscillation and movement. For instance, a trend day. Price opens up. It might be narrow for a little bit, build a bunch of volume, and then it goes really quickly. It's stepwise up. Build a bunch of volume. Now, between that build and the one before, you got a low volume area.
Right.
Okay. And on a trend type scenario, what can keep you safe is that this will just keep stepwise happening, and it doesn't change until it starts escaping the lower volume nodes.
Ooh, light bulb just clicked there.
Yeah. So in reversion trading, I don't care if it's at the 9th standard deviation from your volume weighted VWAP or from your moving average. If you're building a distribution there and it's still respecting the low volume areas below you, then she ain't done.
Right. Oh, wow. Okay.
Wow. Yeah.
That feels really powerful.
So that's a really key component to it. I talk about that as much as possible because for the most part, it's going to keep you. It's at least going to keep you safe.
Yeah, how many times I can't even count how many times that I've looked at a move that's continued, like it seems like it's overextended, it's continually going up, and you just keep thinking to yourself, this can't keep going up, and then you try to fade it, and then you get burned.
I'll throw a short on here.
Yeah.
But meanwhile, if I was paying attention to some of these other areas of interest and how price is respecting those boundaries, if I was aware of that, I would not even be attempting to fade at that point.
Well, think about it this way too. Let's say you're somebody who, and I don't condone averaging over a wide range. Okay.
Right.
Let's say that somebody is trying to do that, and they enter, and it steps up, builds volume, and has an LVN below it. Now, it not only has to get through that to get back to your position, but if you go ahead and average, and your average is now on that LVN, now support is at your entry.
Right.
You know what I mean? And so it's going to show you why that doesn't work.
Mm-hmm.
Okay. And so I like to be a little bit more specific with entry placement, and it either goes my favor or it's off. Yeah. Another way to view volume, and probably the most common way that traders use, is volume per candle.
Yep.
And so you have a time-based candle, like a 5-minute candle, and then underneath of it, you see a histogram of the volume moving up and down. And so that is not something that I personally utilize.
Is there any particular reason why?
It doesn't give me as much information for my style of trading.
Okay.
So the one thing that I will utilize that for is like on a daily chart. I'll glance at that like recently, like these large pushes down.
Mm-hmm.
We talked about a parabolic blow-off. It accelerates. You get a volume spike, and then it just V-shapes out of there. So it's an exhaustive type move, and you can probably narrow that down on smaller time frames. I just don't.
Mm-hmm.
Yeah. The next one is volume per second. So volume per second is the amount of volume coming in to the market each second, and it's calculated based upon that time speed, that speed of time. So it's like a pace of tape almost. Okay.
Oh, okay.
So if you're looking at a time in sales and you see all those colors flashing in front of your face, you'll see sometimes it moves quicker and sometimes it moves slower.
Mm-hmm.
Volume per second can show you if interest is growing and accelerating, if it's decreasing. If you have a breakout and volume per second increases and price is going with it, then that's helping confirm.
I have never even considered that type of candle. I don't think I've even heard of that. Is it called something different, or is it?
It's not a candle, but this is something that you can get information from your footprint chart, and the calculated values that occur with that. And you can also see this visually with your time in sales, which takes a little bit more experience and understanding that as that pace of tape picks up, you can visually see it flashing in front of your eyes, seeing who's at play and what side they're on.
Mm-hmm.
But in a more simplistic sense, if you were to pull the calculated values like from your footprint that's showing the volume per second, you can even map it in a way that meets your eye personally. You can throw, I don't know, a 5 unit EMA or something on it and just see it oscillating, right?
Mm-hmm.
And that's another way to visualize that. Now that's zooming way in, but on entry, that's going to be a very clean way to kind of see, is that speed picking, is that interest picking up, and is it picking up in the direction of your position?
Right. Is that utilized in the OFL tool, the reconstructed tape?
The reconstructed tape. So the reconstructed tape is showing the trades and the orders coming in, so it'll be printing faster.
Mm-hmm.
Yeah, so you'll see it. You'll see it as that occurs with the reconstructed tape.
Okay.
Yep.
And then the other one on here, volume per trade.
Yeah.
I see that a lot of your guys' studies reference that, but I was just curious what the reasoning behind that is. Like, what's the benefit?
Yeah. So volume per trade, like a trade candle. If I want a candle that's the size of 1,000 trades,
Mm-hmm.
well, I can have two candles next to each other that are both 1,000 trades, but one has 17,000 volume and the other one has 200 volume.
Oh, trade, not volume. Okay.
Right. Or it's going to have 1,000 volume. At least it's going to have at least 1,000 volume. So as that volume picks up per trade, well, there's heavier positioning occurring.
Mm-hmm.
And so if it takes 1,000 lots at minimum, if you got 1,000 traders trading on one lot, you can create a candle. But if you have 999 traders trading one lot and then one person trading 700 lots, it's going to have more volume than the previous candle.
Uh-huh.
And so the volume per trade lets me see, are we working with a bunch of one-lotters, or are we working with a little bit more meat behind these trades?
It's bigger, deeper pockets getting involved in the move.
Yeah. Yep. And so you can also see that the volume per trade on your time and sales.
Mm-hmm.
So it might flash, a sell order that came through, and if you filter it by trade size, you might see it pop through as like 150 lot come through where you were just seeing flashes of 2s and 3s.
Mm-hmm.
Okay, and so that's going to be important. That's going to be isolated as one trade in that candle, but you can start to see when participants are becoming active in that.
And then back to the volume per candle. I think that was the one I was confusing when I was asking about volume per trade.
Volume per candle is just if you have a generic candle and you're displaying the volume underneath that candle based upon a time setting.
Isn't there one where you can set like this number of?
You can do volume candles.
Like this. I want the candle to close whenever 1,000 contracts have traded.
Yeah. So why would I do trade number over volume size?
Mm-hmm.
Is because if that candle is getting ready to print a new one, and let's say it's on 1,000 volume candle, and it's sitting right around like 850, and somebody comes in and slams 700 lots. Now it's spread through candles.
Okay, so you missed some of the information, or it splits it up.
It splits it up. Yep.
Okay, that makes sense. All right. What about? Let's see. You also got ask volume and bid volume on here.
Oh yeah, the ask volume is simply the if a buyer comes in and buys at market.
Mm-hmm.
Okay, then what they have to do is reach up above market price, and that comes in as ask volume. So it's reaching up to grab the ask.
Okay, so it's trades that are occurring at the ask, or so basically looking at
market
people
trades.
Marketing in. Yeah.
Yep. So market trades, and then making the bid volume, people reaching down and hitting the bid.
Why is that important? So
if they're pushing through, if they're not a limit order setting on there, you can actually sweep the book, and what that means is if you're looking at a DOM or a depth of market,
mm-hmm.
on the buy side, you're going to have at each tick level, you're going to see a certain amount of lots. Okay.
Right.
And if those next 8 ticks resting liquidity is only 200 lots, but somebody comes in and at market sells 1,000,
right?
Then it's going to wipe right through those down further, right?
Mm-hmm.
And that's a sweep. They're sweeping that entire piece of the book. And so mapping out the ask and bid volume in that with that respect to your time and sales is a very clean way to see a transition there. Now, along with that, there's different ways to take this ask and bid volume, because the ask minus the bid volume is going to be delta.
Mm-hmm.
Delta meaning it's the ask minus the bid, but essentially, what is the dominant market participant here?
Right. Are the sellers or the buyers being more active?
Right. And so if price is pushing down, and starting to slow down, and down there all you have is sell delta,
Mm-hmm.
but it's not really making progress, then boom, it can flush them. It can push up and stop them out and accelerate away.
Uh-huh.
And that in itself is something I referred to as offsides delta, and that's a trade setup that I utilize.
I think we're going to probably have to do a much deeper dive into delta at some point.
Also, you're gonna want to make sure that the delta master himself is on.
Oh, who's the delta master?
Flurry.
Flurry? What?
Yeah, he's the delta wizard.
He's been holding back on us.
Right. I thought he was just a market profile wizard.
Oh man.
Yeah, so that's something you probably definitely want to dive into.
Yeah, we'll make sure we definitely get that on the schedule. In the meantime, though, let's move on. You got VWAP on here as something that you wanted to talk about.
Yeah. So VWAP. VWAP is the volume weighted average price. It's calculated simply by the sum of the price times volume divided by the sum of the volume.
Mm-hmm.
VWAP is a very common tool used in intraday trading, and it shows up or displays similarly to a moving average, but it's taking into consideration the volume, and therefore presenting the presence of fair value as it relates to all of that transacted volume.
Mm-hmm.
So with VWAPs, I put a lot of weight on the full session, or the 24-hour, and then the RTH only. So it starts at the start of the RTH. And then a third way that I utilize this is with anchored VWAPs.
RTH, just in case anybody doesn't know the acronym, regular trading hours.
Mm-hmm. The cash open. Yep. And so anchored VWAPs are positioned. You can manually start them wherever you'd like. And I like to use those at swing highs and swing lows to help guide me from a shift in the auction direction.
How do you define a swing high or swing low?
So where you have a specific extension or rotation away from a high or low.
Mm-hmm.
And so if we're slow grinding up and building rotations and distributions, then all of a sudden we have a sharp move against that takes out a couple distributions, pushes through some LVNs. Then now you could start an anchored VWAP from where that began, and that's going to show you the fair value of the volume that started, boom, right there.
Oh, okay.
Yep.
Interesting.
And so we actually have a video that discusses these three. It's only 5 minutes long. It's on our YouTube channel. I recommend checking it out. But I dive into charts and go through that, and it provides information, a little more information on that.
Awesome. Make sure we link that too.
There's also resting liquidity, which is untraded volume. So whether or not you put importance on that, there's a lot of different schools of thought. But if we have a larger order sitting on the books, it can tend to act as a magnet.
Mm-hmm.
And if it fills, then that's more important than if it lifts off. So if it's pulling price in a direction and it removes, then price can accelerate. If it fills and price cannot continue to go against it, then you can have initiation or other players coming in to push price
Mm-hmm.
in the direction of that fill. Yeah. So that in itself is more of a DOM nuance, but it's something to consider. And it's not volume that's transacted; it's just resting liquidity. But it's something to take into consideration when you're watching the stuff occur on an intraday basis.
So what's the difference between something that should be pulling? Because sometimes you hear people talk about the DOM, you see like a big order there and you think that's a magnet, price is going to be pulled towards that. But sometimes you see the book just look super thick on one side and that makes you think that, it's going to be really hard for the sellers to push through this.
Well, I mean, resting liquidity, especially if they're refreshing and reloading.
Okay.
As those orders are filling, if they're filling more limit orders and then you see that number be replaced or refreshed, there's more of a intention there.
Are you talking about like an iceberg order or just the numbers that you can see resting on the DOM where they trade 100 there, pops up back above and the guy throws another 100 lot back on the same price?
let's say they're just the whatever's resting on the DOM. Let's say it's transacting. Let's say they're selling into a 100 lot order, right?
Mm-hmm.
And you see 12 lots get taken up. It goes down to 88. It goes down to 75. It goes down to 60, and then all of a sudden, boom! Now it turns back into 100.
Okay.
So they're refreshing that order.
Mm-hmm.
So there's going to be a little bit more intent behind that type of sequence from that order that's filling.
Right.
And so they'd be roping in. And so essentially, in that sense, if they're filling that sell order, okay, and that sell order just continues to refresh and refresh and refresh, you're building a ton of that bid volume, that sell delta, right?
Right.
And then if that builds enough of that there and then pushes against it, pushes up, now you can start triggering stops, and that push out can accelerate. And as price moves away and FOMO starts to kick in, then buyers can follow.
I noticed with the liquidity zone study that OFL uses, there's an activation for it. So is it when you're watching this like take place, like price comes into an area where there's somebody refreshing their bid, like how far does that need to pull away before you start to think that okay, those guys are trapped?
That's a setting that you can actually manually change, depending on what type of candle you're looking at with your footprint. And so we typically have 40-point move away is going to activate it. If, anywhere in the range of 30, 40 points is going to be good and ideal. You don't want it just moving away 4 or 5 points and then coming back in. Specifically with NQ,
Right.
On ES, it's going to be different. Depends on the market that you're in, and so if they build that out and then boom, they reverse it, then it's typically very responsive upon the return. And so I utilize a point and figure type candle on that, and not to dive into the point and figure and reversal types that create the candle, but it's just a non-time based candle that I'll gather that delta information in to create a liquidity zone.
Now, when you see something like that happen, like how are you making use of that information? Are you waiting for price to pull away, come back and retest it, or are you trying to just
a lot of times I'm on the first move, because watching that delta come in cluster that creates that zone is pretty easy to risk against.
Mm-hmm.
As long as it's not continuing and accelerating, if price is pausing and building that in, then I'm somebody who'll put risk on and stop just below.
Right.
And then as that pop and pushes out of there, follow the move up, engage it with a volume build. But upon return, what you expect is, I guess the thought process is trap positioning there either needs to get out. Maybe they're underwater, or more importantly, somebody was interested there.
Mm-hmm.
And so upon that return, why are they still there?
Right.
And a lot of times they are.
Is that where the how far you want to see them pull away comes into play? Because I remember hearing Flary talk about one of his live streams about the reward that traders got for engaging at a particular area. Like if somebody,
that actually that does change per market that you're trading.
mm-hmm.
But obviously, if there's a lot of transaction occurring and they're not going anywhere, it's not going into their favor at all, then that's going to create essentially, if you think about like population dynamics, it's going to create fear and anxiety in a couple of those participants, right?
Mm.
And if they exit, let's say they exit as at the lows there, and they turn into a buyer, because if they sold the low, they have to buy to get out of the position.
Right.
And so if a handful of them turn into a buyer to get out, and then a handful of them more get a little bit spooked, it can set off a chain of events that accelerates away.
Sometimes the market seems so fragile where it only takes a few participants to really shift a sentiment.
Yeah, that's just a very generic way of, kind of getting an idea of what's happening there.
It makes sense. And I think it is helpful sometimes to put yourself in the shoes of the person you're trading against. Like if you want to be long, like what are the shorts thinking right now? If you were a short, would you be scared? Would you be excited?
Yeah. Right. And it comes with experience, comes with watching it.
Mm-hmm. So back to the VWAPs then. You said you put most of your weight. So the ones you mostly pay attention to are the Globex and RTH and the anchored VWAPs. Are there any other?
The week.
Okay.
And that's it.
Okay.
That's it.
All right. Well, we got a whole bunch of terminology that maybe we should go through with reading the actual volume profile. So I've got this thrown up on my chart, and there's like shaded in areas. There's areas marked out as the POC, the highs and lows.
Yes.
Like, why are those important? Why are the people paying attention to these areas? What are they?
So where you have the high volume peaks on the profile, that's called a high volume node. Where the volume is less, or you have little valleys, that's called a low volume node. All right.
Mm-hmm.
The largest one is going to be called the point of control. It's just simply the place where the most volume has transacted.
Mm-hmm.
Now, a profile is going to be based upon a certain time frame. Like if you're looking at the day, the 24 hours, right?
Mm-hmm.
You're going to have volume built throughout that day, and it's going to create a profile. Think of it like a distribution curve again.
Right.
Where 70% of that volume has occurred can be shaded and stamped as this is the value area. That's where 70% of the volume has transacted. And so that value area is going to have what? Edges, right? It's going to have a high part of that value area. It's the value area high. And then you have the low part. Those value areas, those references are important because there's a lot of interest within those bounds. Right.
Mm-hmm.
Also, the expansion and contraction of them. If it's a really tight zone, okay, and value is just compressing, you can assume that an expansive type auction is going to occur at some point.
Okay.
Or if values spread out really wide on a wide, thin profile, then you can assume that we're going to get some contraction.
Why would contracting days lead to a bigger move? Is that just because the stops that are building up each time it does contract as people trade those edges that continuously shrink?
If contraction occurs indefinitely, then price will just wind up being the same forever.
Right.
Right. So the auction is going to then invite participants in to find new areas of value.
Mm-hmm.
Okay. And so based upon whatever changes occur, in the world or in the environment of that particular security, that price exploration, it's going to build that acceptance to a certain degree until other time frame participants come in and press it out away.
Mm-hmm.
And so upon an expansion from a heavy contraction, you don't want to fight it.
Right.
That actually comes into like intraday application.
Okay.
So if you were to take, for example, and separate like the overnight and the RTH,
mm-hmm.
okay, as two profiles, and then you zoom out and you see a couple days worth, and you got maybe like 6 or 8 profiles up, okay?
Right.
If they're kind of overlap, you see 4 or 5 of them kind of overlapping in a little zone, draw a box around it. Whatever the highest high was as far as the value goes and the lowest low of the value.
Okay.
In that little consolidation. Now you have more of a conglomerate or an aggregate of value that has been formed in your previous 6-8 sessions, right?
Mm-hmm.
Therefore, you know that if the low end of that base is even 200 points away on NQ, but today, okay, we auction straight down 180 points. It looks scary. You know that at the bottom end, you're technically still in an area of value.
Okay.
And so you may get participants coming in at the lower piece of that and then taking it back to the other side.
Mm-hmm.
Okay. But also, if you box that in and then the next day gaps up, now you have an upper end of value that well, if it gets back into that zone, it's rejecting above.
Right.
So that's just a way to apply that upon an intraday sense.
Okay.
Okay. Utilizing that as key zones for interaction and placing trade against. So that's just the basic terminology of value area, high, low, point of control, the high volume nodes, low volume nodes. to see this is different than listening to it.
Right.
And what we can also provide a link on the YouTube. We have a go through of volume profiling. All right.
The two-parter that you did.
Yeah, I believe that's up there, right?
Yeah, I think we shared that for people before this came out too. So
Yeah.
hopefully they've already watched that.
Okay, great. That's going to provide just a base of kind of so you can see what as we're speaking to it. Now, some nuances with the volume profile, and I mentioned before tapers and builds and what leg we're on. A taper is when volume dwindles, and so it creates a little thin tail.
Mm-hmm.
And so as price moves down and decreases in volume, if price moves back up, then that tail is showing a rejection.
Okay.
All right, that taper is showing a rejection. Also, if you're in a position, let's say you're long, and price is going up, 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 but it's tapering, it's probably a good time to have tight risk.
Okay.
All right. Conversely, a build, if you're in a position and price is pushing up and it's starting to taper a little bit, and then boom, it starts to build a node.
Mm-hmm.
Now you're finding you're at least seeing interest in the direction that you're moving, right?
That's so weird because I don't know how long. Like when I started looking into this, for some reason, like the idea that volume is showing up at these areas, like price jumps up, volume builds. I always thought of that as sellers are interested here. That means that they're getting ready to push it back, but that's completely opposite of what is actually happening.
I mean, it certainly could just be sellers, right? But the reality is, unless it gets back into the previous distribution or gets under that LVN, it's not moving against.
Mm-hmm.
You know,
Yeah.
And so one of the phenomenons you'll see on even on a trend day, you'll have negative delta on the way up.
Right.
Right. Sellers there's no way I'm selling here, and then it's just fueling that push.
Right, because they keep turning into buyers, and then as price moves against them, then they're having to exit and cover.
Yeah. Yep. So on a leg-to-leg basis, okay, visualizing these builds and tapers is important. On a leg-to-leg basis, what I mean is, let's say you enter position near a low, and it goes in your favor, and you're managing the trade. I'll manually draw a volume profile starting at that low, drag it out so that it builds from that start point. I've got a fresh profile. It's not mixed with the other volume. And I'm going to watch these little nodes build and build, provide other little LVNs along the way that I can manage my risk and stops against.
Ah.
And by rule of thumb, once it starts moving, I definitely want to be taking portion of the position off at 2R and then trailing. I'll manually move my stop 2 LVNs behind position.
Okay. So that gives you some room for it to pull back a little bit deeper.
To move, like on a runner. Yep.
So you're using these volume nodes almost as like the map.
Yep.
Man,
fantastic.
It's exciting.
Really awesome. Yeah.
So you gave us some examples then. Do you want to clarify our homework assignments for this episode then?
Absolutely. Need to really just look at them, watch them, and then pit them against the prior session.
Right. Okay. So
okay.
Let's see. So you map out our map prior day VP and compare to current day.
Yeah. Where's the primary low volume areas from the previous day? By primary, I mean the deepest.
Sorry, say that again.
Where's the primary low volume nodes from the previous day or previous session even? Primary being the deepest low volume node. If it pushes through a prominent low volume area, then it has the propensity to auction to the other side and circle around that volume.
That's task number 1.
Yeah. Task number 2, group up the zones of value to get an idea of, well, is value consolidating and then stepping up and consolidating, stepping up? That's time framing. That means that the auction is just moving and accepting. Even though there's rotation, there's rotations for both sides of trade within that, you can see that the big picture is a direction or the other. This entire leg down that we had recently, value is not building above. day in and day out.
Mm-hmm.
And then all of a sudden you get the shift, okay? And then it starts to go stepwise up.
Right. All right. So group zones of value to see how value is consolidating in the big picture.
Yep.
Anything else?
And then on obviously as a position or as the profile builds, if volume is building, she ain't done. It has to get back under the low volume node and find interest there. You'll see you'll be able to see it when they get up there, and then it's dwindling. It's smaller nodes, and then all of a sudden it starts to come back and reclaim those LVNs. Then you get a shift.
All right. So I have as profile builds, observes how volume builds and price reacts.
Yeah.
All right. Anything else for the homework assignment?
That's all. That's all. I think we went through a lot of information. I appreciate you guys having me on here.
Well, I think if we got some time left, maybe we can do some Q&A here.
Sure.
Listener questions. Question 1.
Try to find. Okay, Paul D wanted to know how much value would you suggest giving to the VPs of different time frames? For example, like a 60-day versus the Globex versus the daily. When does the VP from the RTH come into play in your plan, if at all? And how far back do you volume profile?
I typically volume profile back a week to 2 weeks. Now, I would say when it comes to your question about 60-minute or this or that, just keep it the same. Keep your variables the same, because I know, like Baba Yaga, and there's a few people that I've traded with for some time, and they'll put on like just a 30-minute profile or a 15-minute profile, because it'll just keep updating, and then they have their full session with it.
Mm-hmm.
Okay, and so that's another way to kind of see that auction, inside the auction.
Okay.
But if you have a 60-minute profile, that's not wrong. It's just I don't recommend having a 60-minute, a 5-minute, a 30-minute, and just all these different time frames. I would say have a base, have your session always printing, at least to be aware of what's happening right now. You can come inside that and have, your 10-minute or your hour or things like that nature.
Mm-hmm.
And that'll help with it.
But mostly it's consistency that you're saying, like getting familiar with the charts that you're looking at all the time.
Correct.
That makes a lot of sense. Joel wants to know, is a rolling 5 or 20-day profile as useful as drawing a profile on like a specific balance area or group of days?
Yeah, so this is a cool concept that's up for debate. So one of my ways that I plan, especially at the end of the week, is that I'll just zoom out on a 30-minute chart, right?
Mm-hmm.
Or an hour. Really, the time bar doesn't matter. Where's the high and the low? Okay? And so if the high comes first, then I'm going to go back further. I'm going to go, okay, I'm going to start at the low. I'm going to draw it all the way out. And then I'm going to draw it from the high. Now I got two. I got one drawn from the swing low, one drawn from the swing high, and I can easily see where those prominent LVNs are. So you said a rolling 5-day, a rolling 20-day.
Mm-hmm.
Absolutely fine. You're still going to get the information to see where that lack of interest is. Okay? It's going to provide different levels than the individual who's mapping specifics of each session or the specifics of each day, right? But it's going to give you the standout information like a prominent low volume area and that value shifting up and so forth. So it's not that those levels are wrong if they don't match up with people that you're seeing on Twitter or so forth. It's just specific to the time frame you're viewing. And so I am on board with a rolling 5-day, anything like that. I think it's good to group them.
How
to get an idea.
One of the things that I think we were discussing not too long ago was like the reason why some things work is because everybody uses them. Like, is there benefit to trying to be as conformative as you can to watching what is the bulk of all traders are looking at, or is it better to just be familiar with something that you like and that works for you?
Man, I'm just a weirdo.
We all are.
Yeah. So the systems that I have in place, like the routine, I guess you say, what I'm looking at, the way I'm I'm doing it, has been developed from a lot of time just diving in on this.
Mm-hmm.
And so it allows me to have a consistent, non-biased means of seeing what's happening. And so I don't leave much up for interpretation.
Right. Okay.
And so if it comes down to, well, I have a point of control here, a value area low here in this LVN, but of these three, we're going to get an interaction, but I'm thinking that this one's going to be the best one.
Mm-hmm.
Like I'm not in that party.
Right. Okay.
I know what I want to see on a bigger time frame, and it ultimately doesn't change all week. As the week goes, then I'm engaging between each session to adapt to that around those larger zones.
Mm-hmm. Awesome. Okay, last question that I have so far here is from VL. He would like to know what the best way to use an LVN in single print on the daily chart.
The best way to utilize it?
Yeah.
Draw a horizontal line. When price gets near it, is it accelerating or pausing?
Mm-hmm.
If it's pausing, and in that session it's tapering, and you're above it,
mm-hmm.
prepare for a move to protect that LVN.
Mm.
Because what you'll see is on that higher time frame, that's an area that needs to be, that's an area of inflection.
Okay.
And if it moves through it, it's going to be very swift, and it's going to build volume. It's not just going to sit there and just dwindle. And so, especially on a return, you're looking for protection. You're looking to trade against it.
Okay. All right. Dan, do you have any questions?
No, this has been a really amazing deep dive into all of the volume indicators that are out there. I love it.
All right. Looks like we're good. Let's go ahead and let's wrap this up.
Oh, fantastic. Thank you so much for joining us, Job. This has been really amazing.
Hey, thanks for having me. I have some examples from my notes here, speaking points that I want to provide images for.
Yeah.
And I might not be able to get to that, finish that today, but it can also be released at a later time.
Well, whenever you get those together, let's just dump them in the Back to the Futures channel, and I can pull them from there.
Oh, wow. Okay, so we unfortunately got to wrap up. We can't talk forever. We don't have infinite time.
Yeah. Well, the guys at OrderFlow Labs have real jobs.
I know. They're so professional. And we are so very, very, very blessed to have you guys joining us. Thank you again, Job.
Hey,
and
thanks,
thank
guys.
everybody listening for sticking around to the end. I hope you've had as great a time learning about volume as I have. And I hope you're eager to get back to trading futures yourself to try and apply some of these lessons.
Future.
Back to the future,
Marty.
We've got to get back, Marty. Stop trying to fuck your mom and get back to the future.
Jesus Christ.
Anyway, on that note, we'll see you next time, folks. Happy trades.
We'll see you guys. Bye.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks in the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.
Sometimes you need to take control to make a difference. That's why with FlexPath from Capella University, you're in control. Set your own deadlines and leverage your experience to move at a pace that works for you. Discover a different way forward at capella.edu.
Bundling car and renter's insurance with Geico is so easy, your neighbors are probably already doing it. But who? Look for the signs. Chances are they live in a home and have a car. They use money and enjoy having more of it. They probably drink lots of lemonade. Lemonade. And they've probably said something suspicious like, "I'm bundling with Geico," or "Stop spying on me with those binoculars." If so, you may want to ask them how easy it was to bundle with Geico. Bundling is easy with Geico. Just ask your neighbors.